Welcome to this video. Today we explore the hidden tax dangers when a foreign pension or investment fund is created in your name, even without your consent, and how that can trigger significant UK tax liabilities. We will discuss UK worldwide taxation, penalties, essential do's and don'ts, the right way to disclose, and how to protect yourself by engaging the right experts. Let's begin. In this agenda, we'll start by framing the problem, then move into the UK's worldwide taxation rules. Next, we'll examine the potential tax rates and penalties. After that, we'll walk through immediate do's and don'ts, a practical case study, and decision flow. Then we'll address common questions and finish with key takeaways. Now, let's frame what's really happening. Many UK citizens and long-term residents discover that a family member or associate set up a foreign pension or investment fund in their name. While it might appear generous, it can be a serious legal and tax risk if you are legally considered the owner or beneficiary. Under UK rules, you may owe income tax on any withdrawals, potentially at higher or additional rates up to 45%. Moreover, failing to disclose a foreign financial asset can result in significant penalties. With that context in mind, let's understand the UK's worldwide tax rules. For UK residents, worldwide income and certain gains are within scope for UK taxation. This means that if you are the legal owner or beneficiary of a foreign pension or investment fund, you must disclose it to HMRC. Importantly, withdrawals from foreign pensions are often treated as income rather than capital gains, which can result in higher tax rates, potentially up to 45% for additional rate taxpayers. Failure to disclose can lead to penalties, interest, and extended assessment windows for offshore matters. With the fundamentals established, let's visualize how decisions should flow after discovery. This flowchart illustrates the recommended path. After discovering a foreign fund in your name, the first instruction is to avoid contacting the foreign bank or signing any documents. Instead, seek UK tax counsel and an international lawyer. Next, determine whether you are truly the owner or beneficiary. If so, prepare a controlled disclosure to HMRC that evaluates income tax treatment, open years, and potential penalties. Submit the disclosure and settle tax, interest, and penalties. Alternatively, if evidence supports that you are not the owner or beneficiary, counsel prepares a response and handles communications. Throughout, the diagram flags the risks of high penalties and income tax rates. As soon as you discover the fund, engage a specialist UK tax advisor and an international lawyer. Preserve every piece of evidence that could prove you did not authorize or contribute to the account. Allow your advisors to communicate with HMRC and any foreign institutions to avoid missteps. Do not sign documents or acknowledge ownership, and do not contact authorities directly. Also, avoid moving or withdrawing funds until you receive tailored advice. Now let's compare income tax treatment with capital gains, because this distinction is critical. On the left, we have income tax treatment, which often applies to foreign pensions and annuities. These withdrawals can be taxed at higher rates, including 40% or 45% for higher and additional rate taxpayers. Tax is due when the funds are taken out. On the right, capital gains tax generally applies to disposals of assets, and often at lower rates, such as 10% or 20% for most assets, though certain property can be higher. Pension-like products typically do not benefit from capital gains treatment on withdrawals. With this contrast in mind, let's review potential penalties and triggers. This table gives an illustrative overview of penalties. Failure to notify penalties apply when you do not inform HMRC about taxable offshore income or assets. Deliberate and concealed behavior attracts higher penalties, sometimes up to 200% of the tax due. Offshore penalties can also reach up to 200%. Particularly under regimes like the requirement to correct for historic offshore issues. Interest accrues on late tax until payment. In serious cases, HMRC may publish details, creating reputational risk. Next, let's test your understanding with a quick quiz. Question: if you are the legal owner or beneficiary of a foreign pension set up abroad, who is typically liable for UK tax on withdrawals? Options: A. The foreign bank. B. The relative who set it up. C. You, the UK resident owner or beneficiary. D. No one, if it was a gift. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Under UK worldwide taxation principles, the legal owner or beneficiary is typically liable for income tax on withdrawals from a foreign pension. This can be taxed at higher or additional rates depending on your circumstances. Now let's walk through a practical, anonymized case flow. This sequence shows a common flow. A relative opens a fund in your name without authorization. You immediately engage UK tax counsel, who coordinates with an international lawyer. The lawyer obtains documentation from the foreign institution, while you avoid direct contact. The advisor conducts a pre-disclosure review and then manages a controlled disclosure to HMRC. HMRC requests further information and calculates liabilities. Your advisor explains the tax due, interest, and penalties, and how cooperation can mitigate them. Finally, you settle the liabilities through the advisor-managed process. Let's consider the professional roles and how they shield you. This sequence diagram emphasizes how advisors intercept communications. The client connects to the UK tax advisor, who coordinates with the international lawyer. The lawyer engages with the foreign bank for documentation, while the advisor manages HMRC disclosures and responses. The client avoids direct contact, reducing the risk of inadvertent statements or acknowledgments. The focus is on compliance, mitigation, and careful evidence gathering. Moving forward, let's outline the professionals you need and the documents they will ask for. You will need a specialist UK tax advisor with offshore experience and an international lawyer familiar with cross-border finance and fraud. Prepare an evidence pack with account documents, correspondence, identification, and any proof that you did not authorize or fund the account. Your advisors will assess whether you are legally the owner or beneficiary, which tax years remain open, and how HMRC might categorize behavior on a scale from reasonable care to deliberate and concealed. They will propose a disclosure route and mitigation strategy. Next, let's place these steps on a timeline. This timeline outlines a pragmatic first 90 days. In weeks 1 and 2, you triage the situation, preserve evidence, and appoint advisors. In weeks 3 and 4, advisors assess ownership and risk while running pre-disclosure checks. Weeks 5 and 6 focus on drafting the disclosure and building the mitigation case, while the lawyer gathers bank documentation. Weeks 7 and 8 cover submission to HMRC. Weeks 9 to 12 involve HMRC's follow-up queries and advisor-led responses. After week 13, you move towards settlement and ongoing monitoring. Before we continue, we need to cover an important disclaimer. This content is for educational purposes only and does not constitute legal, tax, or financial advice. Your specific circumstances may change the analysis and outcomes. You should consult a qualified UK tax advisor and a lawyer before taking any action. Do not rely solely on this video to make decisions. Now let's address some fast FAQs in a concise, markdown-style recap. Here are concise answers to frequent questions. If you are the legal owner or beneficiary, withdrawals from a foreign pension may be taxed as income. You should not contact the foreign bank yourself. Penalties may be reduced with cooperation and strong evidence, but outcomes vary. While capital gains tax can be lower, foreign pension withdrawals are usually taxed as income. Obtain specific advice. If you did not authorize the account, your advisors will compile evidence to challenge ownership and handle HMRC communications. Next, let's reinforce the decision process with a flowchart quiz. Question: what is the safest first step after discovering an unauthorized foreign fund in your name? Options: A. Withdraw the funds immediately. B. Call the foreign bank to close the account. C. Contact HMRC yourself to explain. D. Engage a specialist UK tax advisor and international lawyer. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is D. Engaging a specialist UK tax advisor and an international lawyer creates professional insulation, reduces the risk of harmful admissions, and supports accurate disclosure, which can help mitigate penalties. To close, let's highlight the key points you should remember. The key points are as follows. UK residents are taxed on worldwide income, and foreign pensions are within scope. If you are the owner or beneficiary, withdrawals are usually taxed as income, not as capital gains. Penalties for non-disclosure can be severe, though cooperation may mitigate them. Do not sign documents or contact institutions yourself. Rely on professional intermediaries. Compile evidence to support non-authorization if that applies. And work with your advisors to plan a controlled disclosure to HMRC. Finally, let's summarize the journey end to end. To summarize, treat discovery as a high-risk event. Pause, preserve evidence, and immediately engage professionals. They will assess ownership, tax years, and behavior, then prepare a controlled disclosure to HMRC. After responding to queries, you settle tax, interest, and penalties, then close the matter and monitor for any further issues. As we wrap up, here's how you can help others stay safe. Thank you for watching. If this video helped, please like it, share it with someone who might be at risk, and subscribe for more guidance. Share your questions or experiences in the comments. Your perspective could help others avoid serious problems.